But we're gonna talk a little bit about what's been going on in crop markets, both for the 2020 crop and then have a real quick look at the 2021 crop. And so when we look at kind of where we've been, this graph kind of shows the futures, the harvest futures contract for our four primary row crop commodities. So you can kind of see the end of 2020. This is the blue line here. We're well above $11 for soybeans. To the 2021 crop, we're right around that 10.50 range, which again I think is a reasonable place to start pricing. But you see that dramatic run up that we've had in both soybeans and then also in corn in the end of 2020. Started back in August and has pretty much carried on through the remainder of the year. July wheat futures started moving kind of sideways around that $6 range. We haven't really seen much in terms of cotton. We kind of got back to where we were before COVID-19. And since then, we've kind of just been bouncing around between that 68 and 72 cent range. And so one thing that we always want to factor in is obviously futures is part of the equation to the price that we end up getting for our commodities, but basis is an equally important component. And so when we look at soybeans and corn, we have the 5-year average in red here, and then the 2020 basis so far in gray. And what you can see, I don't think this is going to surprise a lot of people, but 2020 has not been a normal year on pretty much any front that you can imagine. And what we've seen is we've seen pretty strong basis numbers in soybeans, and in corn, you know, we haven't seen those deep declines, and a lot of it is to do with what's ended up occurring, you know, domestically, and what's ended up occurring on the export market. So when we think of what really caused, because this is really going to feed into where our expectations are moving as we move through the remainder of 2020 and into early 2021, and what's going to affect some of the planting decisions. There's kind of two big causes. There's other things that are going on in the background, but the two main drivers over the last 3 months in terms of what's affected row crop prices has been weather. Obviously, we're more familiar with what's going on domestically, but there's an equal or maybe even more important component going on internationally. So we'll talk a little bit about that. And then obviously trade, you know, export sales, and whether we're going to be anywhere close to meeting the Chinese phase 1 commitments is another one that's really important. So when we look at kind of drought in the West, and I use the West very, very loosely, obviously, we all know about Texas and New Mexico and Colorado. I'm going to kind of focus in kind of more of that corn, soybean, the Western Corn Belt. And you can see back in August 11, we had some problems in Iowa that did ended up resulting in some substantially lower yields. That kind of spread through a lot of that Western Corn Belt. And what we've seen is some massive reductions in what production was initially anticipated at and where we're at right now. And so a real simple example of this is Iowa corn yield. So back in August, USDA was projecting 202 bushels per acre. In November, they're now projecting 184 bushels per acre, which doesn't necessarily sound like a lot until you translate it over that substantial acreage, where you have 2.7 billion bushels versus 2.3. That's a 401 million bushel reduction, or about 3 times what Tennessee produced or is expected to produce in 2020. So we're talking about some substantial reductions in production. And when we look at that, it's something that's going to be very important as to where we're going as we move forward. But that's not the only weather story that's out there. We have some substantial influences that are affecting corn and soybean markets in other regions. The first one, and I'll show some of the data in terms of what trade or export expectations are, is out in the Ukraine and in parts of Russia. That's affecting both our wheat markets and our corn markets. You go down into South America, you have that delay in planting. They've got most of the crop in now, but there are some pretty severe concerns about dry weather conditions. There's been a lot, if you follow any of the weather news that's out there, talking about the La Nina weather effect. Typically, you will end up seeing dry conditions emerge in parts of Brazil and Argentina, and then also dry conditions potentially in the American Southwest. And so we're seeing those phenomenon. And it's really important because right now we're looking at, you know, November, December is when Brazil is typically having their corn pollination. You know, they have soybeans in such a wide area, but most of their soybeans are going to be harvested in February. So again, there's still time to improve some of these conditions, but it is concerning in terms of there's basically three major countries that you can get soybeans from or soybean products from. That's Brazil, Argentina, and the US. And so when we do see a drought phenomenon down there, obviously that's going to amplify concerns about supplies and drive those prices up. And we've seen that tremendously in soybeans and to a lesser extent corn. So when we look at US corn production, I'm going to throw this up real quick just as kind of a comparative analysis. When we look at what we really want to focus in on is this ending stock number, where we've seen it continually decline. So where USDA has it 1.7, projected farm price of $4. So again, that doesn't necessarily translate to Tennessee prices, but it does give you a benchmark to think of, okay, well, where were the national farm prices and what were those prices in Tennessee? So again, you can kind of end up translating that. And what we're looking at is kind of back to 2013, 2014 levels when you factor in both stocks and you factor in consumption, so exports and production. So again, when we talk about stocks to use ratios, you know, we're talking about having a set of circumstances where, are we out of corn? No, but we've seen a substantial tightening of those stocks relative to the amount that we're using and exporting. And again, what we've seen is driving this is we've had very strong exports and domestic consumption, and that has exceeded what our production has been for the last 2 years, and that's resulted in a decline in stocks. And to just kind of highlight how big of a change this was from May until November, these are the projected numbers for the 2020 crop for both May and November, and then what the change was. And you can see these reductions are substantial when you look at, you know, 7.1 million acres harvested, a reduction of 2.7 bushels per acre. The production number, 1.5 billion bushels of corn, less than what was projected in May. And then you also have this demand component as well, which typically when we end up seeing reduction in supplies and prices go up, we see demand kind of pull back a little bit. What you can see is this fantastically strong export sales number of 2.6. That's up 500 million bushels. And what that translates into is a much, much lower ending carryout. And we've seen that both domestically and in foreign stocks. And so when we talked about that stocks to use number, it went from 22% down to 11%. And we've seen an estimated price increase of about 80 cents per bushel. When we're looking at kind of the global picture, this is that same information. So we're looking at the May estimate versus the November one. You can see we've almost declined 2 billion bushels in total ending stocks. The vast majority of that has been in the US, but we have seen production disruptions in key production regions like Ukraine. That translates into their exports, and then the EU as well, where we've seen those dry weather conditions. When we look at global corn exports, this is kind of an interesting tale when you see where there's been changes from the primary exporters. We have the 4 countries here that are really the dominant export players in global corn markets. From 2019 to 2020, we went from 1.78 to 2.65 billion bushels in the US. Brazil went up a little bit, but the other 3, rest of the world, Ukraine and Argentina, all declined a little bit. And a lot of that feeds back into that global weather that we've had, where there's been disruptions across multiple regions. This is the one that's really a positive news for the US producers and the relationship with China. So we track weekly corn export sales. So we're looking at this by marketing week. And so this is what you can end up seeing in terms of the blue bars, and these are stacked on top of each other as accumulated exports. So those are exports that are shipped out. The current marketing year outstanding sales in orange is what's been spoken for in terms of sales that are outstanding, that have not been shipped yet, but that have arranged some type of purchase arrangement. And what you can end up seeing is right now we're just over 10 million metric tons, and we're only 9 weeks into the marketing year. So we're pretty much double the next highest full marketing year total. Now, again, it is really important to point out the distinction between accumulated exports. So those are ones that conceptually you can think of as those are shipped versus outstanding sales, because shipped versus outstanding sales are not the same thing. We hope that those materialize, and most of them likely will materialize into export shipments, but they have not yet. And so again, one thing that'll be really important as we go through this winter season is whether these outstanding sales materialize into accumulated exports, so actual shipments out to China. When we look at soybeans, this is one that how quickly this changed is really phenomenal. If you think back to 2018, Obviously, one of the big reasons why we end up seeing this buildup was the trade disruption with China. We went from almost 1 billion bushels to where now we're almost projected to be out of soybeans again. So we're looking back in kind of that 2013, 2014 range in terms of what we have left over according to the USDA. And that's translated in price. And I think there's still the potential for some additional upside price in soybeans for the 2020 crop. But there is a lot of uncertainty out there. A lot of it's going to depend on how accumulated exports materialize for soybeans and what ends up happening down in South America. So you have to remember, since they were delayed planting, what you will end up seeing is delayed marketings. And so again, typically China moves some of their export sales business, not shipments, but actual sales purchases to South America in December and January. And then they have shipments kind of March through the remainder of the year. So again, that's something that's going to be really important to pay attention to. But the big one here is demand is at an all-time high and our stocks have shrank tremendously. So again, that's really positive in terms of prices as we look at the end of the 2020 and into 2021. This is an interesting contrast between corn. This didn't really come around because of a major production disruption. If you look at where production was compared to May versus November, it was actually up a little bit. Where this ended up coming to fruition was when you look at crushing up, exports up. And so again, we ended up seeing fantastic demand. And if you really want to end up having higher prices that are reasonably stable, you have to maintain those demand sources. And so this is a real positive for soybean prices as we look at the end of 2020 and into 2021. When we look at globally, there has been some production disruption. So Argentina's one where they've reduced the amount of production that they've anticipated for the year. A lot of that is some of the drier conditions that ended up occurring down there. When you look at ending stocks, Brazil is estimated to be well down from where they were. A lot of that, again, is tremendous Chinese trying to increase their or get enough soybeans for their increasing hog herd as they rebuild from African swine fever. And so we look at this again, you know, I think we've probably talked this to death by now, but it really is a three-player game when we look at the soybean markets. We have the United States, we have Brazil, and then China is going to take about 2/3 of those countries' exports. So again, following what happens in China is so important to the soybean market because they are such that demand center, right? And again, you can see that impact when we think back to 2018, 2019, when we had the retaliatory tariffs and some of the trade disruptions. Look at that dip in soybean exports. Now, there's always going to be some degree of backfilling, right? So if you're not shipping to China, maybe we're shipping a little bit more to EU, but you're really playing around on just that 1/3 on the top rather than the 2/3 that are going to China. Same accumulated export picture here. You can see this cycling is marketing year. So these would be the 51 weeks that they end up having for marketing year sales. But you can see where we're at right now. We're only, again, about 10 weeks into the marketing year, and we're already at about, I think, 82% of what the USDA was projecting. It doesn't look as dramatic as corn, but you have to remember you're not comparing this little peak here with the peaks here, you're comparing it to week 10. So again, fantastically strong export sales. The big thing is, again, they have to matriculate into actual shipments, which I think for soybeans, because there's not really that much doubt that China is going to continue to need to have soybeans to feed some of their livestock industries. I think this is a reasonably safe bet. But again, one thing that you do want to end up being cautious with is, are you going to displace demand someplace else as these prices continue to end up rising? I did promise I'd put one cotton slide in, and this is one that's kind of problematic from what I can end up seeing. If you have cotton stocks to use ratio, so we're taking how much we have in reserve versus how much is being used for China, US, and the world. China is kind of its own animal because once cotton enters that system, you know, it comes out as a finished product. So you have to be careful with that. They had that big run up back when cotton prices got real expensive in 2011. And then they've eaten into those stocks. But if you look at world stocks and US stocks, we have very high stocks levels. And I anticipate that we will continue to see prices until we get more advantageous stocks to use levels in cotton kind of running between that 60 to maybe 72 cent range. And the reason why I bring that up is if you think about what's going to be planted in 2021, that is something where there could be a pretty dramatic shift when you think of the Mississippi Delta in terms of what acreage is going to be planted, because right now it really isn't looking positive for increased cotton acreage. And again, cotton is one of those ones that's probably been hit the hardest out of all the commodities from COVID-19, because it's just evaporated a lot of the retail sales that are out there. There's some online transition going on, and it's kind of potentially been accelerated, but that's really kind of been problematic. I did want to put in one wheat slide for those of you that have wheat planted or wheat growing. Wheat prices have been very strong. You know, $6 is a pretty good starting point on the future side. There are some concerns though when you look at global stocks. And so when you look at stocks over time, we're continually increasing, but we do want to adjust that for demand through the stocks to use ratio. But you can see that's also increasing. Now, what's fueled this one higher is if you look at the Southern Plains, obviously there's some real production concerns there. There's some production concerns in Europe, in Ukraine, in Russia. But as far as being out of stocks, similar to what we talked about with soybeans or even the massive reductions in corn, that hasn't matriculated in wheat. And again, when you think about that, that is problematic long-term to maintain or continue to see those prices climb. I'm not nearly as bullish on the wheat side as I am on corn and soybeans. So when we're looking at moving forward, it's going to be challenging to end up predicting which direction price is going. But again, the two big ones are going to be monitoring that weather down in South America, how that crop progresses, and then do these Chinese purchases actually end up turning into export sales. And so when we look at those weekly export sales, I think it's going to be really important how rapidly they translate from a sale into an actual export. When you look out to 2021 crop prices in terms of planting intentions, currently soybeans favor corn, but that's pretty close, particularly in Tennessee when we have such a strong basis. You know, if you're in southern middle Tennessee or East Tennessee, you can get some really advantageous basis levels versus soybeans. Again, you do have to factor in that regionalization of the prices, but these two are close. But cotton, I just don't see a lot of incentive to end up planting cotton as we move into 2021 unless we see prices change. There's still a lot of time between now and then. So, I mean, a lot can end up changing in terms of prices and what's going on from a supply and demand standpoint. But I don't anticipate cotton, given the stock levels that we have and kind of the lagging demand from the COVID-19 pandemic, that's going to bounce back dramatically in early 2021. There could be a set of circumstances where we get a small rally just to try to increase that acreage for just the ginning and making sure that there is some additional cotton that is coming out of the U.S. into the export market. One that's a real big unknown right now, and this is one that's incredibly challenging because we don't really have a good idea of which direction this is going to go, and that's the implications from the election on farm policy. There's not a lot of information, concrete information out there as far as what a Biden administration might look at for farm policy. There are certain, I guess, popular press articles that have kind of speculated on what some of the priorities would be. I would not expect to have the same level of direct payment support under the Biden administration as the Trump administration. Now that, again, is also a function of where we are in terms of prices. The other one that's really important is with the transition of the Senate and House Ag Committee leadership. It'll be real interesting. They'll start negotiating the Farm Bill. I think it'll be very telling who the new Secretary of Agriculture is as to which direction they want to end up going. If it's somebody like Colin Peterson, who has a lot of experience in negotiating traditional farm safety net programs, I think that's a positive sign. If it is somebody that is more focused on food and nutrition, I think that could signal a real change up in what we would anticipate moving forward in a new farm bill, because those negotiations will start occurring. I know the current one doesn't expire until 2023, but very important moving forward what that safety net looks like and what the priorities are of the administration. So take home, I'll close with this one. I threw in my little holiday flair, my favorite holiday movie of all time, Planes, Trains, and Automobiles. This is kind of my point. I don't have a crystal ball. I don't know what prices are going to do between now and the start of 2021. They could definitely go higher. There's tons of bullish momentum. There's not a lot of resistance when you look at the top of the technical charts for soybeans, but they could also decline. You know, if we do end up seeing trade disruption, or if we do end up getting some,
hey, what's going on?
South America, you know, that would.
Hey, can you hear me?
Yeah, we know my cell phone doesn't have much use on it, but I'm on my way to a meeting.
Are you?
And yeah, I just seen a dog.
There we go. But when you look at that, you could end up seeing a pullback too. You know, when markets get overheated, technically you will usually get some type of correction. So I'd be cautious about that. So from an old crop standpoint, if you look at where we're at right now, and I recognize that most people have done probably a pretty substantial amount of selling between August and now. So we're just talking about the tail end of this crop. If you do have a substantial amount, you know, 1150 and 425 plus basis plus the government payments, that's going to make a profit for most Tennessee producers. I think honestly, if you average for 2020 in that $10.50 and $4 range, you did pretty good. These are futures prices, so again, adjust for your regional basis. But you know, I think those are some pretty good numbers. If you do still have a little bit left in storage, you know, and you want to see where this market goes, you know, I don't have an issue with people, you know, continuing to hold out, but I would be very leery if you're not, if you don't have a substantial amount already priced, holding out for higher price levels than what it is. You know, it can be one of those ones where taking some profit now can be beneficial. When we look at new crop wheat, I really think the time is to be a little bit more aggressive on wheat sales, up to 50%. You know, some people aren't comfortable going that high, but getting to that 25 to 50% for 2021 when July futures are greater than $6, I think is great. I've been beating the drum pretty hard on wheat in terms of locking in a futures price, or at least a futures price floor, and letting the basis do the work for you as you enter the harvest season. So, or if you're going to store, having the basis work out of the harvest season. So again, I really like that $6 target in terms of being pretty aggressive with prices, just because the world supply and demand picture, one, there's plenty of stocks, and two, it can change so dramatically because we have production in both hemispheres and on pretty much every continent. When you look at new crop corn and soybean, start pricing with harvest futures over $4 and beans over $10.25. I don't think you need to get aggressive, but you know, just dipping your toe in and getting some production priced, I think it's a reasonable starting point, just to kind of price incrementally, starting now and moving through the planting season and the production season. You know, getting, you know, 10% might be a good starting point for people. Again, these are futures prices, so if you price using either a cash forward contract or option, you want to take that into account. But I don't mind getting a little bit of 2021 production priced when we're at these levels. Close up with cotton. The current price offerings are just not competitive with corn and soybeans. I'd have a tough time making an argument to plant cotton. I hate to say that, but I really think you need to see something closer to 74 cents before it makes sense from a competitive standpoint with current beans and current soybeans and corn offerings on the December 2021 contract. And so with that, I will close down